In general, do you think we're seeing a structural shift, not only in how countries are running themselves fiscally and also from a monetary policy standpoint, but also longer term in how markets are behaving? And I ask that knowing that you've written quite a bit about, for example, this clustering, if you will, of wars and sovereign debt crises, and then how all of that can play out in terms of movements around populism and then funnel back into markets.
Yes, I think in the past 7, 8 years, the U.S. and some other countries have entered fiscal dominance, meaning that basically fiscal deficits and very high public debt levels in general have changed the nature of how impactful monetary policy can be. So monetary policy is not really like the brake that it used to be when they're trying to get control of inflation. And we're basically pre-stimulating as long as we're running deficits of this size in the U.S. and certain other places. And so things tend to run hot. We tend to have higher nominal GDP growth. Asset prices in dollar terms tend to be stronger than many bears expect. And yet, for example, stocks have underperformed gold over a multi-year stretch. And, unfortunately, these things, like you mentioned, these things do tend to cluster. So as you get higher public debt levels, people often ask, when will 39 trillion public debt matter? Well, I mean, that's a symptom of now decades of financial imbalances. And so there's been winners and losers of that whole process. And I've argued that it's contributed to populism. It's contributed to, more significant and more unexpected geopolitical issues. And I also think we're entering just a more multipolar world in general. And a lot of these forces, of course, impact portfolios that were very different than, say, the 40-year stretch of declining interest rates from 1980 to 2020.